Welcome back to The Explainer. I'm absolutely thrilled you're here today because, wow, we are looking at a fascinating case study that perfectly captures the wild, high-stakes mechanics of crypto markets right now. We're diving into the recent market debut of $CHIP, the native token for the USD.AI protocol. Let's start fast by dropping this absolutely massive number, 506%. Now hold on, that's not a price gain. That actually represents the staggering trading volume to market cap ratio that the CHIP token hit on its very first day of trading. Think about this. It saw $820 million in trading volume on just a $162 million market cap. Just to put that into perspective, normal tokens in this range, they usually sit at around 10 to 30%. Okay, let's dive into this. How exactly does a highly anticipated AI token generate over 5 times its own market cap in daily volume, push to all-time highs, and then watch its price completely collapse by 62% just days later? That's the core mystery we're unpacking today. It's this stark disconnect between massive market hype and an immediate price collapse. Section 1, the explosive chip launch. Let's rewind to the chronological beginning of this market drama, taking us back to the token's debut in April 2026. So the token dropped on April 21st, 2026, and the team utilized an incredibly aggressive launch strategy. I mean, usually most tokens start small, right? They slowly expand to larger exchanges. While not $CHIP, it launched with simultaneous Tier 1 listings across major platforms like Binance, Coinbase, Robinhood, KuCoin, the whole shebang. This removed all the usual access barriers and brought in instant institutional-grade liquidity. It drove that staggering $820 million in 24-hour volume we just talked about, rocketing the price up 370% to an all-time high of just over 14 cents. But, as you'll see, that incredible parabolic momentum violently reversed. Within a matter of days, the token shed over 62% of its value. It dropped from that 14-cent high way down to around 5 cents, putting it dangerously close to its initial 3-cent ICO price. So, you gotta ask, what caused the floor to literally fall out here despite record-breaking volume? Section 2. What is USD.AI? To truly understand the collapse, we actually have to shift our focus away from the volatile trading chart for a second and look at the underlying technology itself. USD.AI is, fundamentally, a GPU-backed lending protocol. Think of it like a decentralized platform where AI hardware operators can tokenize their physical GPU rigs, the actual hardware that powers artificial intelligence, and use that as collateral to access on-chain financing. I want to make this completely clear for everyone. This is a real-world infrastructure project. It's facilitating millions in loans and connecting real-world computing demand with blockchain financing. It is absolutely not just another speculative meme coin. And $CHIP? Well, that's the governance token for this entire ecosystem. Holders of $CHIP get direct voting rights over absolutely crucial protocol parameters. They control the risk and credit policies, deciding things like collateral eligibility and interest rates. They vote on fee structures, the protocol's insurance framework through the staking module, and all future protocol upgrades. Basically, by holding this token, you're essentially holding a voting share in the interest rate of AI. Section 3. Strong fundamentals, volatile chart. This brings us right to the hype versus reality dynamic, where we're seeing a massive disconnect forming between what the protocol is actually doing and what the token price is showing us. Now, what's really interesting about this slide is how perfectly these two sides clash. On the fundamental side, it is incredibly bullish. I mean, USD.AI boasts over $100 million in active loans, a massive $1.5 billion pipeline, full integration with PayPal's PYSD stablecoin, and institutional custody through Anchorage Digital. That is huge. Yet on the chart side, it's aggressively bearish, a brutal 62% drop driven by heavy selling pressure. As market analysts at CoinGecko pointed out, and I quote, "The protocol is not struggling. The price is high. That gap between fundamentals and price action is exactly where traders need to pay attention. The underlying business is growing rapidly, which, leaves traders both completely confused and really intrigued by the token's current struggles." Section 4. The supply overhang risk. So to understand why traders are dumping a fundamentally strong project, we have to pull back the curtain on the real catch behind this massive sell-off, the tokenomics trap. Notice the massive dilution risk at play in the supply distribution here. Only 20% of the total chip supply is currently in circulation. Let that sink in for a second. That means 80% of the 10 billion maximum tokens, that is 8 billion tokens, are locked up, unvested and just sitting on the sidelines waiting to enter the market. Let's walk step by step through how this structure literally fueled the 62% crash. First off, public sale buyers on CoinList paid just 3 cents per token. Second, those public tokens launched with absolutely zero lockup period, none. Third, when that aggressive Tier 1 listing strategy pushed the price up to 14 cents, it basically handed those early buyers a 370% gain in a matter of hours. So step 4 is pretty obvious, right? They immediately booked massive profits. The crash wasn't a failure of the protocol at all. Actually, it was just highly predictable profit-taking. So the crucial point is this major valuation gap. While retail traders might look at their screens and see a seemingly accessible $162 million market cap, the true economic weight of the token, its fully diluted valuation, or FDV, is actually 5 times larger, sitting way up at $810 million. Any new buyer has to absorb the reality that the supply is going to expand massively over time. Section 5. What comes next? With the initial launch volatility finally starting to settle, we have to look at the future outlook and how the market is projecting the protocol's next 12 to 24 months. Analysts are basically looking at 3 distinct short-term scenarios. In the bear case, if selling pressure continues and the broader AI sentiment cools off, the token could bleed right back down to its 3-cent ICO price. The base case assumes the protocol's total value locked, or TVL, continues to grow, leading to a slow technical recovery somewhere between 5 and 8 cents. And then, in the bull case, if institutional adoption scales rapidly and features like the PayPal integration really boom, we could definitely see a return to that 10 to 15 cent range. To achieve that bullish outlook, USD.AI's roadmap relies heavily on pure execution. They absolutely must focus on deploying their capital at scale, deepening institutional partnerships globally, and most importantly, growing real yield from real hardware. That is absolutely crucial to ensure the protocol's value outpaces the eventual token inflation. On top of that, they're utilizing incentive programs like their Flatiron points and airdrops just to keep liquidity providers engaged and happy. Let's move to and see how this builds into the broader timeline. Following the April 2026 token generation, we are currently sitting right in the summer rewards phase. By Q3 of 2026, the market is going to be watching closely to see if they can successfully scale that massive $1.5 billion loan pipeline. And honestly, all of this is a literal race against the clock leading up to April 2027. Why? Because that is when the major investor and team token unlocks begin, which will flood the market with that massive locked supply we talked about earlier. Which brings us to our final, ultimate question for this explainer. The tech? It's real. The institutional partnerships are for sure real. But man, the tokenomics are heavy. Will USD.AI's real-world revenue actually scale fast enough to outpace its looming 2027 token dilution? That is the million-dollar question. Keep your eyes locked on their quarterly loan originations, because that's exactly where the real answer lies. Thanks so much for joining me today, and as always, keep learning.